we talk about macroeconomics, and one of the ways that this American Rescue Plan has been promoted is that it's necessary economic stimulus to create jobs and bring the economy back to full employment. I would suggest, and even staying out of all the politics surrounding the American Rescue Plan, that there are actually 4 different major areas to think about with the American Rescue Plan beyond, or 3 other areas beyond its effect on the overall economy. And I'd say the first one of them is the goal of the plan to mitigate all the economic hardship we see in the economy. Secondly, to stabilize the economy, but to do it in an equal and equitable fashion. So to have stabilization of the economy, really consumer driven rather than driven by Fed policy, let's say. A third consideration of the American Rescue Plan and part of the debate is the question of moral hazard. In other words, are we losing economic discipline because the federal government is supporting a variety of different programs here that may discourage sort of the normal operation of the economy. And then I just want to go through these other points and then to hone in on the focus of macroeconomics. Is like, what is the macroeconomic argument that we're making here, and how that holds up. So the first issue that's being addressed is mitigating hardship. So and it sometimes is kind of conflated with the macroeconomics, because the point is we need the rescue package by and large because millions are out of work through no fault of their own. There's hopelessness, hunger, crime, and then furthermore with this whole COVID recession, there are like high levels of reported anxiety, depression. So there's a crisis which is a COVID-related crisis, an economic crisis, and a large goal of the rescue package is just to mitigate that, to make sure that people who need food, people who need their rent stabilized, people who need their lives stabilized, have that help. And the American Rescue Plan, part of the component is just to mitigate some of this short and long-term societal damage that we've had from the COVID pandemic, the closure of the economy, and all the disruptions that it's created. Second factor would be equity and equality economic argument. So this is a little bit separate from, do you have economic growth? Do you have growth in GDP and growth in employment? To say is, if we're going to have this growth, will it all just go to the well-off with a K-shaped recovery, or can the economic recovery be broad-based? So the argument here is that in the status quo, there have already been a couple of major rescue packages, about $3 trillion of that, but there's been a very heavy involvement of the Federal Reserve, which has stepped in to stabilize the economy with very, very low interest rates and promising near zero interest rates indefinitely into the future. And then this spring, a $3 trillion expansion of the Fed balance sheet, which is essentially the Federal Reserve is creating money to buy up assets, and this has been primarily in the form of Treasury bills. So the Fed buys Treasury bills from the federal government, and also there's been a significant portion of this has been mortgage-backed securities, which is basically taking individual mortgages, bundling them into a security, and then the Fed buys those. which then has the effect of driving down the interest rate on T-bills and also driving down the interest rate that you would have for getting a mortgage. So kind of the status quo situation has led to asset inflation. So basically, if the Federal Reserve is taking a major role to stabilize the economy by, let's say, you could call it subsidizing mortgages and lowering mortgage interest rates as just one example, then that tends to drive up the value of housing. So it's somewhat interesting in this terrible economic recession that actually the price of home values has gone up by 8 or 9% over the last year, and then also asset inflation in other categories, the stock market, and then we all know about Bitcoin and just general asset prices being driven up, and to the degree of speculation. So the argument about the equity and equality is kind of the status quo with like very, very high liquidity has led towards a K-shaped recovery. So those who own assets, who have stocks, who own a house, have seen the value of those assets go up over the last year. This sort of K-shaped recovery means that the top of the K is people who are well off, and that's a line pointing upward, meaning recovery. And the bottom part of the K is the vast majority of people who've seen their economic circumstances decline over the last year. So the status quo, by all the liquidity, the low interest rates, the Fed actions, means that those who have assets do well, and then also those who are connected to, let's say, the technology industry or Wall Street, those professional jobs have also been doing well. Furthermore, many of the professional services jobs, technology jobs, and other jobs can safely be done as work by home positions. So then, furthermore, this means those who can comfortably move to a work from home environment have done reasonably well, and have certainly participated in the recovery out of the sharpest dip of the recession. And those who can't work from home have done very poorly, and there have been major job losses in hotels, hospitalities, and all sorts of industries. So the reason to have a fiscal response is in the context of having a weak economy. The response needs to be like increasing liquidity, perhaps running a deficit, and then fiscal policy can then determine who gets those resources. So the government determines, rather than just mortgage rates are subsidized and people who own houses see the value of those houses going up because of all this liquidity, the fiscal policy can then target, if the Fed is to increase its balance sheet, where's that money going? So for example, if you have an across the board $1,400 check that goes to all individuals, then you're heating up the economy, you're propelling economic growth, but it's really targeted towards a per capita distribution of this additional liquidity, rather than just lowering interest rates and increasing the money supply. So that is sort of one of the goals of the American Rescue Plan. So there's hardship, and then also the idea of having more equality and having broad-based payments on a per capita basis instead of just continued efforts by the Fed to add liquidity to the economy. Another issue that's come up quite a bit in terms of the previous stimulus packages that we've had and the new American Rescue Plan is the issue of moral hazard. And moral hazard is basically saying is the government is there to bail out people who've taken on too much debt or companies that haven't managed their finances well, or a variety of ways where, in fact, you may be ending up with sort of a long-term dependency on government programs rather than a short-term program to stabilize things, but then businesses and individuals need to work to make money and manage their own finances and operate without that government support. So a few different examples of this are extended unemployment, which has been criticized for increasing the income for some select people. Those who are laid off from a job may make substantially more income than people who continue a job and do not have a layoff. So when you have a very high unemployment benefit, it actually raises the income for people who lose their job over people who stay working. There's been criticism of the rescue of the airlines, which use their financial resources to buy back shares of the airlines in good times. And then when you hit this pandemic, the government comes in with financial support. Airlines do have, I mean, clearly the pandemic is not airlines aren't responsible for that. It was a very, very hard hit, but the airlines had very little buffer room in case there was a pullback in the demand for air travel, which has happened, from time to time over the decades. Student loans, paycheck protection program, state and local spending. This is a big argument that if you forgive student loans, or if you support small businesses, or if you fill the gaps in state and local spending, that is then encouraging people not to take a loan obligation seriously, for example, or state and local governments may feel they don't really need much of a rainy day fund because there's always a backstop with the federal government. But with all these problems about a new package with moral hazard, there's also moral hazard in the Fed always stepping in to stabilize financial markets. It's called the Bernanke put, the idea that if the financial markets become very unstable, that the Federal Reserve will make sure that liquidity is provided to the market, so that financial companies don't face default risks. The old too big to fail idea. So if we jump into the macroeconomics, the basic Biden macroeconomic arguments are, first is the need to go big. And this is what Janet Yellen is saying. We need to go big. We need to run the economy hot. And secondly, that you need economic stimulus to get to full employment. Fed policy alone is inadequate. You need a stimulus package to encourage demand for goods and services. That if you have low interest rates, companies still won't invest if they don't see that there's going to be demand for their goods and services. So you need both the accommodative monetary policy, but then also stimulative fiscal policy, so that if it's just monetary policy, but there's no demand, then monetary policy will just be pushing on a string. The interest rates are very low, but there's no reason to invest. So this is the idea behind the need for fiscal policy. A third argument is that just the risk factor. So that that the Biden administration sees the risk of going too small is that you could end up in a deflationary cycle. That people pull back spending, then inflation is very low, or actually prices are going down, and people will defer spending because they'll see that prices are getting lower into the future, and you have a lot of risk-averse behavior, and ending up like the lost decade, quote unquote, lost decade in Japan, where prices went down year after year. Individuals, consumers were very risk-averse and kept a lot of money in savings. Consumption went down, and then you had a negative cycle. As consumption goes down, business activity goes down, and you end up in a negative deflationary cycle. So part of the idea of the stimulus is really to reflate the economy, to push back up demand, so that instead of prices going down, prices will go up. On average, at the 2% target of the Fed, and the Fed is and the Biden administration has indicated a willingness to have inflation go up beyond that 2% for a number of years. And then there's also the mistake of, in retrospect, many in the Biden administration were there at the financial crisis, and in retrospect, they say, well, in the financial crisis with the ARA plan, 78, 87 billion, the mistake was it went too small. It should have been 2 trillion at that time. And the lesson that was learned is don't go too small. There was an economic recovery during the Obama administration, but it was very slow, very gradual. So there's a feeling within Biden administration officials is we need to go big, and we didn't go big enough in the financial crisis. And finally, another argument is that the latest employment reports have been weak, and that if you want to bring people back to work, you really need to run the economy hot to make sure that people come back into the workforce. So then we've conducted economic modeling on this, and looking at the macroeconomic framework and the size of the stimulus package, and our U.S. macroeconomic assessment of this issue is basically the bottom line is that the 1.9 trillion goes far beyond what's necessary for economic stimulus. So if we just kind of run the numbers here, is over the course of the past year, the economy has lost about 12 million jobs. We already had a stimulus package in December, as well as the CARES Act. So our economic forecast, also using the RSQE national forecast from the University of Michigan, which then forms the basis of the REMI national economic forecast, gives you a status quo which accounts for the stimulus that came in December and the earlier stimulus, but not the American Rescue Plan, that 7 million new jobs are projected to be added to the economy from that low point of losing the 12 million, 7 million will be regained. So now you're still at a 5 million job deficit from where things were a year ago before the start of the pandemic recession. And then if we're looking at a traditional Keynesian stimulus, about $200 billion is enough traditional Keynesian multiplier stimulus to create 5 million jobs. Now, that's sort of this bare minimum. It's not even clear if you can pull all those 5 million jobs back in, because there are a lot of reasons that people are out of work, other than there's not enough demand in the economy. But theoretically, if you're just looking at that Keynesian approach, and you need to have enhanced demand to bring back jobs, about 200 billion additionally would create those jobs. Now, 200 billion is sort of like the bare minimum, and we do accept that there is downside risk in ending in a deflationary spiral, so that 600 billion would provide a little insurance against that deflationary stagnation cycle, would run the economy a little bit hot, push the inflation rate over that 2% target. And then also the American Rescue Package is really at its core, a lot of these policies from a macroeconomic point of view are directly targeted at addressing the issues of the COVID economic shock. And these are supply issues that they're restrictions on reopening. They're safety issues, so it's related supply and demand issues. First, the activity may not be open because of various opening restrictions, and secondly, COVID affects demand because people don't want to risk catching COVID. So COVID has hit both the supply side due to closures, and the demand side is that people don't want to do activities that put them at risk. So a lot of this American Rescue Plan addresses issues specifically related to how do we reopen the economy. And that's where we're going to begin to focus on in some of the modeling that we do. So the risk of going too big. So pulling on the really the macroeconomic side, there are significant risks of going too big. It's really different than the Great Recession, so we can't necessarily just go back to the playbook of 2009 and think that we need to just have greater and greater fiscal stimulus and that will solve all the issues, because COVID is fundamentally different. It depresses demand due to safety and restrictions, and also the unavailability of supply. This new package is so high, it's almost 10% of US GDP in addition to the $3 trillion. So we expect that the stimulus will be inflationary. Now, the magnitude and timing is very difficult to assess. There's a high level of uncertainty about what happens when the economy reopens by midsummer or September. It's highly uncertain as what level of price pressures there might be. Will speculative bubbles emerge? Will that be disruptive? So the conditions that we're operating is very difficult to assess with a high level of certainty. but there is a great deal for inflationary pressures with 1.9 million new trillion new package. And then also another concern about this new package is that it's fundamentally short-term. That unlike the ARA, which was expenditures that would occur over 3, 4, or 5 years to stabilize and grow the economy, the American Rescue Package is one time. The idea is to get money into people's pockets as quickly as possible. So after 2021, you no longer have this fiscal stimulus, and there's a great deal of risk about what's going to happen in 2022. Do we need to continue with stimulus, or can we just have this for 1 year and then take it away without disrupting the economy? And then also this short-term emphasis also is neglecting government investment in education, infrastructure, energy, generating long-lasting productivity improvements. So 1.9 trillion for short-term economic rescue. There may be an opportunity cost in terms of long-term investments in the productive capability of the U.S., for example, like with rural broadband or other types of infrastructure development. So where does economic modeling come into all this? First of all, we want to look at the stimulus effects of the American Rescue Plan, and then we'll just do that in an exercise where we show that if we're looking at this Keynesian stimulus shock, that about 200 billion will, if that were the only issue, where extra demand in the economy would be enough to create replace the 5 million jobs that were lost in our baseline forecast. Then we also want to look at really what I would suggest is the core issue, which is the American Rescue Plan, that the main macroeconomic, or a very important macroeconomic upside of the American Rescue Plan is, does it help the economy reopen? And does it help roll out the vaccines, help the schools reopen, help the rest of economic life get back to normal, and support that reopening of the economy, which is beginning to occur, and hopefully will gain a lot of steam as we get closer to the summer. And then we also want to look at the state level effect, and then we are regional economic models after all, and we are focused on state and city and regional economic analysis, and we will look at that state economic effect and dynamic revenue effect of government spending. So in the different policy variables that, and I'd like to thank Hao-Jae Guan, who helped go through the package and look at these various provisions, is that you take each of the components here. So there's a direct COVID response, schools reopening, aid to governments, rental and housing support, and child care. Then we assign REMI policy variables to each of these, and a dollar amount. So these are geared towards mounting a national vaccination program, funding school reopening, funding governments for first responders and other essential workers, providing rental, housing, and utilities assistance, and expanding access to high quality, affordable childcare. So in a lot of these provisions, there are very large spending amounts, but as we can see, a lot of these are geared not so much towards the spending effect, but in as the economic driver, but as supporting the reopening of the economy. So the vaccines, the school reopening, the child care will enable people, are all geared towards enabling people to get back to work. And now in our methodology, you know, as we've mentioned, if you put in 1.9, oh, here are the second component: small business support, tax credits, direct checks, unemployment insurance, paid leaves, and others. So the second area of the American Rescue Plan is geared more towards transportation, transfer payments. So basically, if somebody's unemployed, they have extended unemployment, and then the direct checks, which is very significant, an additional $1,400 per capita. This set of changes is geared more towards adding to demand rather than geared towards reopening the economy. So as I said, if you put in 1.9 trillion into the model as a pure Keynesian response, it's far beyond what would be necessary for economic stimulus for 5 million jobs. So how we'd like to approach this is we'll be using a 2-region national model with the state of Louisiana and the rest of the U.S. as the way that the model's built. Our baseline forecast is the national forecast is based on the RSQE University of Michigan macroeconomic forecast. And then we just want to have 2 modeling simulations. One is to put in $200 billion in aid to state and local government, and the result of that is to show how, from a fiscal stimulus point of view, that will create jobs in the economy. And then simulation 2 is focusing on what I think is the more important role of the stimulus package, which is of the American Rescue Package, which is to support the reopening of the economy. And we're going to represent this. About 2% of the labor force has dropped out since the start of the recession. So labor force participation rates have gone down by 2%. And we'll have a simulation to show what if the American Rescue Plan and the administration can reopen the economy to the point of increasing labor participation rates by 1%. So basically getting back a half of that loss. And then we also want to show this in the context, not only how it affects the economy of an individual state, but how a positive economic change can impact the budget through the links between the economy and revenues.